Our next guest says a mild recession is likely. Joining us here at Post 9 is Crossmark Global Investments CIO Bob Dahl. Nice to see you, Bob.
Thank you.
So are you rethinking your views here on the market? Feels like a lot of strategists lately are getting a little more optimistic given the economic data we're seeing and the price action.
They surely are. And I would say those of us who've been cautious, the breadth, Friday, Monday, today, the Russell 2000 doing so well, it's impressive. Now, they were horrible laggers. As of last Thursday, the average stock was down year to date. And so I haven't felt I've really missed anything aside from, the big tech stocks. So, yeah, we have to do some rethinking here.
Based on what? So the jobs report, a lot of people thought was a very good sign. Yeah,
the jobs report, I think it was more mixed. It was on balance positive. But we still have leading economic indicators down 13 months in a row. That's a record. We still have an inverted yield curve. We still have liquidity issues. So I'm not giving up on, look, when the leading indicators start down, the average recession starts 11 months later. We're in our 12th month. So if a recession's coming, Sarah, it's still not late.
A lot of people also say that when Fed hikes, the lag policy is 9 to 12 months. And we got those 4 75 basis point hikes in the middle of last year. So that should start to hit
Totally
soon.
agree. 0 to 5% in a year. That has implications, not just a few banks rolling over and dying and we get back up and dust ourselves off and everything's fine. I think there's more impact to come, a slower
So what do you
economy
do?
in particular.
What do you recommend?
I think you'd be a little cautious on rallies. You let it go. So, we've been in this 38 to 4,200, seems like forever. Now we've broken topside. I'm taking a little money off the table.
Bob, before we got on camera, we talked about how long we've been doing this. Yes. I'm just curious. There is a benefit, which is remembering certain things. Is there a period at all that, that comes to mind that's sort of similar to what we're going through right now, especially given the AI hype?
Yeah, we went back and looked. I hate to say it, but, 99, 2000, that's the only similar thing. Now, the valuations today are not seriously ridiculous like they were then, granted, but the narrowness of the market is very much the same. So this is from the October low, either the weakest bull market we've ever seen from a breadth standpoint or the longest bear market rally. One or the other, and only time will tell.
Well, what's a good tell to know? I mean, are we just going to have to wait, or is there some sense that you can get here? What's your prediction?
I think we're going to have to wait, and if we get the recession, the market will go back down because earnings will disappoint. If the recession has faded into, maybe next year or the year after, the market will be just fine, thank you.
So what would it take to make you turn bullish and get constructive and tell people to put that money that they took off back in?
Better liquidity, leading economic indicators moving higher. The issues that have caused us to be so concerned would just have to stop deteriorating. And that doesn't seem likely, Sarah. The economy is fraying a bit, like the jobs report wasn't perfect. The GDP numbers that we've seen, the consumer numbers, they're good, but they're not great.
Right, but they're good considering all that we've been through, the inflation shock, the rate shock,
totally
the liquidity drain. All of that was supposed to be this big doomsday.
They're not going to fight you.
Banking crisis.
Yep,
bank failures.
Won't fail you. I won't fight you, any of that. So I look at my screen, I see PE on trailing earnings 21 times, forward earnings 19 times. That's not a bargain.
That's a few tech stocks.
Well, back those out. It's still not all that cheap.
So you think the earnings risk hasn't been reflected?
I think that's right. I think the earnings, they've been coming down, and the first quarter better than expected earnings, but analysts did not take their numbers up as much as the first quarter surprise, which means implicitly they're taking earnings out of quarters 2, 3, and 4. And that bothers me.